Welcome to today's webinar. And my name is Efe Julie, and this session came because after sharing a video where I walked through how one might structure a 12 million windfall, I received over 1,000 requests for insurance illustration across my platforms. So people wanted to know how can they, protect their income, how can they build their legacy and whatnot. So that is essentially why I decided to have this webinar. And I also realized that sending numbers without context wouldn't be helpful to anybody. And insurance pretty much works best when you understand what it is, what it isn't, and how it fits into your rather long-term wealth building. So tonight, it is a free educational session. There is no pressure, no obligation. You're not going to expect any sort of insurance sales pitch. And what we are about today is just clarity. And also, again, just to reiterate and emphasize, please feel free to ask questions in the chat as we go along. And before we even begin, allow me to run just one poll so that I can also understand who is in the room. And I'm going to do that right now. Welcome for those who are joining us right now. Asanteni sana for coming. So I'm running a poll. So essentially, I also want to understand, do you currently have any form of insurance? Do you currently have any form of insurance? Thank you so much for engaging. Thank you. Can give it like a few more minutes. Nice. We are at 60%. They do have a form of insurance. 39%, no. Awesome. Welcome everybody who's joining us right now. 58%. Few more seconds remaining. 58%. And then also, meanwhile, for those who do not have any form of insurance yet, when you hear about insurance, what comes to your mind? And again, this is a safe space. I want us to be, free, because it is only when you share what you know is when you get to learn more. So yeah, we are at 57%, 55 going down, 45%. Amazing. Okay. Thank you so much for voting. So again, I can see it's almost 50-50%. Apparently, 55% of you have insurance and 47% of you do not, and the numbers keep changing. So I will have that run even as we continue with the rest of the session. So again, this is very helpful, and it shows that we're all coming from different starting points, which is exactly why tonight's conversation is very important. Now, a few housekeeping notes. So please keep your microphones muted, and I use the chats for questions, and this session is being recorded. And most importantly, ask questions. There are no silly questions here. Now, on to the main part of this session. I am really excited. And joining us today is none other than Mama Bima, who is one of Kenya's, I should say Africa's most respected insurance professional with years of experience helping families and professionals choose the right insurance. And the word there is right. Right? Bolded, italicized, and underlined, and not just any insurance. So today, she'll walk us through the different insurance options, clear up common myths that are pertaining insurance, and help us understand where whole life insurance fits. Mama Bima, take it on from here. Thank you.
Thank you. Thank you so much, Julie. Or should I call you Juliet? Please tell me, which one am I going with? Do we keep to Julie?
I'm sorry, Esther, can you mute? Julie is just fine. Charlene,
Julie
yes.
is good. Good evening, everyone. Good morning, good afternoon from wherever you're joining us, and Happy New Year. As Julie has said, I'm Charlene Kimara, and I want to share my slides before we get started. Just give me a minute to do that. Julie, tell me once it reflects on your end.
It is, yes, yes.
Yes. So I must say, before I start, I'm really excited by the to be doing this. I love to collaborate with one thing that has made me really excited about tonight's session is Julie, you're really brilliant, and you've built a very good community where even I am learning a lot about investments, wealth creation. So to see you also introducing your community to that other aspect of wealth creation that's really ignored, which now comes to putting an insurance wrapper or a protection wrapper, especially on your investments, by doing what we call income replacement and legacy planning. It's just brilliant. I'm really happy to see you also go into that space and spread that information with just so much passion and eloquence, and to get Kenyans really excited and interested in knowing more. So everyone on the call, asanteni sana also for heeding the call and joining this webinar tonight. And this thing, by the way, we will be talking about, as you can see how I even phrased this. I talked of love, insurance, and loss. But that is not a mistake. I like to almost replace life insurance with the word love. And hopefully by the end of the session, you'll actually get to see how literally like loving your loved ones, loving those people who depend on you financially, just even love for yourself, how it plays in this whole thing. Okay. But I also want us to really see how wealthy Kenyans or people who are very
Santi,
financially savvy.
Santi,
Sorry, Esther, your microphone is unmuted. Kindly mute. Lovely. Thank you for that. We'll get to see how, just people are able, how they're able to see, yes, within my financial portfolio, I have the savings as
I think we lost her. Can you? I don't know. Yeah. Let me know with a show of hands if anybody can hear me. Is it my internet or is it Mama Bima's? Okay, okay. I think it's on her side. We'll just give her a few more minutes before she joins in. Thank you so much. We're still running that poll that we'd started running on do you currently have any form of insurance? And then also let me know in the comments sorry, I'm so used to social media, in the chat. When you think about insurance, what do you think? Yeah. Sorry, Mama Bima, you're here now?
we have gotten a blackout. I think we can still power through this. I
Yeah,
have tethered from my phone.
it's okay.
We can do this. So,
Welcome.
yes. So we go straight into it. Julie did a great job introducing me. We don't need to take too much time on this particular slide. I hope I'm audible, Julie.
Yes, loud and clear.
Okay,
Yeah.
lovely. I want us to really ponder on this slide, guys. Okay. I know from the first poll that Julie has run this evening, she asked us, we could see like it was very almost 50-50, 55 to 45 on those who have some sort of insurance and those who probably have not interacted with insurance before. But things on the ground, especially in our country, things are quite thick. We are talking of life insurance uptake standing at a rather really somber 1.16%, guys. So it's telling you that when you are walking out there, only one out of every 100 Kenyans has life insurance. Okay. And there's a very high possibility because, as you'll see a little bit later in the slides, the staple life assurance products in our market are what we call endowment policies, which are either in the form of savings plans or they're in the form of education policies. So you will get to see that majority of Kenyans, even out of the 1.2 percent thereabout, they still do not have the right type of life assurance, especially when you're talking from an angle of protecting your family, doing income replacement, and doing legacy planning. Okay, so now I think even now, as you think about this, I'm wondering, are you part of this 1.2%, or are you part of that 98.8%? Okay, and hopefully in this year, in 2026, we can all get out of 2026 having joined, and even boosted this number to what? Maybe 3%, who knows? Okay. And before we go into a discussion on product, I hope still audible. The lights are back. I hope it will not affect the fact that I'm currently tethering. Yes, but before we even talk about product, I want us to start from a point of asking ourselves, exactly what does, or what can life assurance, or what can these policies for life assurance do for us? Okay, exactly what can they do within that, financial portfolio that I'm currently building? And I want us to start by appreciating the concept of what we call income protection. Okay, because I know a lot of us who are in this call, we are income earners. And the beauty with our income is that through our income, we are able, to possibly afford, to even get that sinking fund that is constantly funding your wealth, your wealth building activities. Your income allows you to own that nice asset. It could be a piece of land, it could be a car, it could be, your income allows you to put your children through school. Basically, our income is a very, very big asset. But you still find that a lot of us have not done what we call income protection or income replacements. And please, I hope we don't confuse this with the kind of income protection we would be talking of in the face of, say, a retrenchment or being declared redundant at work. That is not what I'm talking about here. When I talk of income protection, talking from the angle of, if my family or if my financial dependents need 100,000 shillings from me every single month, or if they need 200,000 shillings from me every single month so that they can enjoy the current lifestyle we are able to enjoy, how do I ensure that that 100K, that 200K is locked in my household, whether I'm there or not? Okay, especially when I'm not there. In my absence, how do I ensure that 100K would continue to come into my household? Therefore, school fee will be paid, food will be will be on the table, bills will be met, and so on. Okay, so when we talk of income protection or income replacement in life assurance, the first thing we need to ask ourselves is, how much life insurance do I need? Okay, so when you are thinking, Mercy, your microphone is unmuted. Mercy Ngetich, when you are thinking of how much life insurance you need, it shouldn't really come from a point of, you know what, get me a quote for 5K, get me a quote for 10K. That is okay, but from the very foundation, when you're thinking of life insurance, start from asking yourself, what does my expense number look like? Like, how much does my family really need? Or how much do the people who depend on me financially, how much do they need? Or even, God forbid, in the face maybe, say, of a critical illness, and we'll get to look at that just a little bit later when we are talking about living benefits. In the face of a critical illness, how much coverage or how much payout, discretionary money, would I need to receive so that it can possibly help me as I seek medical care? Okay.
Yes, we
Or
are
even in the
waiting.
face, Judy, your microphone is unmuted.
It's okay, I've
Or
muted.
even in the face, yes, of accidental disability, how much coverage do I need? So when you think of how much life insurance you need, first, I want you to really think, what is your expense number? Like, how much do you need to run your household, or how much, if maybe currently your key dependents, say, are your aging parents and maybe your extended family, how much is that they are depending on you month on month? Now, for me, for a quick, example, I'll use the number 100,000. That's my number for tonight, 100,000. Okay. And in life insurance, we have what we call the 10-time rule of thumb. Okay. And basically, it's take a life insurance cover. Okay. Now, what we call the sum assured, that is the cover that you purchase. Okay. How much you are insured for, so that unfortunately, in the event of your untimely demise, this is the payout that would be made to your loved ones. Okay. So take your number, because that is a monthly number, remember? Let's first multiply it by 12, okay? Because we want to see how much is this annually, okay? I hope you've already done that. So for me, 100 by 12, I'm already at 1.2 million shillings annually, right? Then now we use what is called the 10 times rule of thumb in life insurance, and you take a life insurance policy that is 10 times that annual number. Okay, so that already tells me I need, at least for me to be able to replace 100,000 in my household, I need a cover that has a sum assured of 12 million shillings. Okay, and I know probably you're wondering, then how does this 12 million sum insured or sum assured, then how does it replace the 100K in my household perpetually? Okay. And it's very simple. God forbid, if you're not there, the insurance company will pay how much to your family as a lump sum? 12 million shillings. Okay. And if they receive these 12 million shillings, all they'll need to do is go to FA Julie, and she shows them where they can invest this money in a low risk product. At that point, the key thing is look for something low risk that can guarantee a 10% net return. Okay. So if our 12 million is invested at 10% net, how much are we getting as a return, Julie, annually? That is 1.2 million annually, right?
Yes.
Yes. And if you divide that over the 12 months of the year,
100,000.
so essentially, if you have a life policy that is 10 times the annual expense number that your family needs, then you are able to replace your income in your household. Okay. Maybe by a show of hands, Julie, we can see if people have understood this concept of income replacement before we move. Okay, that is
You went ahead and made her and everyone else.
sure. Okay, good. So basically, if you've understood, then how do you ensure that you have already locked in? If my family needs 200K, it will be very simple. It's 200 by 12. That gives me 2.4 million. And then now by 10, that means I should have a life cover with a sum assured of 24 million shillings. Are we together? Class, if you allow me to call you that. Can we move on to the next concept? So I'm blind, Julie, I can see. So do we move on? Okay. So now, and what we have just looked at is how to do income replacement. Okay, we are still going to the source of the solution that Julie referred to in her reel. Okay, but first I want us to have a basic understanding of exactly what can life insurance, or what does life insurance do for us within our portfolio. Okay, so we've already looked at how then do you do income replacement or income protection in the unfortunate event of death. Okay, but the truth is, life insurance is not just about death. There are three key risks. Okay, when you go into an insurance class, one of the first things you're taught is life insurance will protect you in the event of three key risks. Risk one is untimely death, especially. Number two, in the event of a critical illness. And number three, in the unfortunate event of a disability. Okay, especially permanent and total disability. Okay. So it's very important that you ensure, because a critical illness or an accidental disability could impact your income, or could impact you to a point that you are not able to draw in your income at the level that you are doing before. Okay, so having a life policy that has what we call living benefits is very crucial. Okay, and your life cover in most instances will have two key living benefits. That's a critical illness rider or benefit, or an accidental rider. Okay, and I wanted us just to rush through this. You've probably had, I know when we think critical illness, we think of the very big illnesses, the likes of cancer, we think of kidney failure, we think of a stroke, a heart attack. But if you're on a comprehensive life cover, you will see it will cover even beyond, quote unquote, the more traditional and more known illnesses. You'll be covered against things like Alzheimer's, against illnesses like total blindness, paraplegia, even rheumatoid arthritis, you name it. What I will say is before you buy a life cover, make sure that you have noted the exact critical illnesses that you are covered against in that policy. It's very important, okay? Because sometimes you'll go into a plan thinking, diabetes is a critical illness. No. And probably that is categorized as a chronic illness. So it's very important that you take note of the exact critical illnesses that are covered within that plan. Okay, so having a critical illness cover is very important, and so is having an accident rider. Okay, now an accident rider is usually two-pronged. It will pay, number one, in the unfortunate event that the policyholder gets into an accident that leads to disability, or the policyholder gets into an accident that leads to death. Okay, and in the case where the accident leads to death, this accident benefit, okay, is paid in addition. You remember to the number that we were calling the sum assured, that was either 12 million or that was, 24 million, depending on your number. Then, in the unfortunate event of a death from an accident, whatever you may have purchased within your accident rider is paid in addition to the sum assured. Okay, so it's two-pronged, but at the same time, if the accident leads to a disability, so that means you're still alive, but now you're permanently incapacitated, this accident rider is paid as an individual benefit, and that is why we call these benefits a living benefit. I remember when I joined the insurance business in 2019. I was coming from corporate. I used to work in investment banking. So when I first got started, I was mainly doing fund management, money markets and so on. And one of my first clients who almost made me a superstar in one of these big insurance companies, she bought a product for 10 million shillings. Okay, at the time, and it was what we call it was a more of a unit-linked product. It wasn't endowment, it was unit-linked product. And her story was so touching. Actually, the 10M was coming from a critical illness payout from her employer-provided group life policy. Okay, so they at work they had a group life cover. She was covered up to 15 million for critical illness. She had just gone through treatment for cancer, like she had been diagnosed with cancer. So out of the 15 million payout that was made, she actually decided, you know what, I'll lock in because she had ample medical insurance. And remember, these payouts are usually discretionary money. Okay, so it doesn't work like a medical cover where the money is paid, say, to the hospital or to the medical care providers. No, in life insurance, the payout is made out to you in cash into your bank account to use as you please. So in her case, she actually locked in that 10M into that product that was called Imarika at the time. And it was my first time seeing, and to date, by the way, she is still such an amazing client. We've walked this journey with her this entire time. But yes, that is why they're called living benefits. Because in 2019, 2020, you can imagine what she was going through, going treatment. This money was paid out to her. She didn't need to utilize the entire amount, and she actually invested the money. I have seen clients receive a living benefit. 2023, one of my clients is diagnosed with cancer. He receives a payout of 5 million shillings. And before he actually traveled to India, for treatment, to seek further treatment, the one thing he did towards the end of November and early December in 2023 was to take his family down to the coast, for a holiday. He wanted at least to spend. I think, was very realistic. He knew this had been caught quite late. He wasn't very sure of what would happen once he travels, So he literally went for a trip with the family. And that's why I say these are living benefits. And this is discretionary money. Okay. Unfortunately, my client passed away 2024 January. He didn't, he succumbed to the illness. But the beauty with it, of course, it's bittersweet to that extent, But I remember even when I would visit him while he was going through treatment, the one thing that he would always say, okay, and maybe this is where we bleep the name of the insurer, he would always say, the best financial decisions he felt that he had done at that point was getting the family a home, because he always felt like his wife will not be left, behind in case he doesn't make it through. She won't be left behind thinking about rent and all, and also getting that cover. He would always call the underwriter. So let's say the underwriter is called F.A. Julie. He would always say, getting that F.A. Julie cover. Do you get? And true, and he's, by the way, sikupigia insurance debe, but even as an agent, when you're able to work with that family after they've lost their key breadwinner in January, of course, they take time to bring him home, go through the burial, get the certificate of death and the claim. And that young girl walks into this office, actually the other side where my husband sits, and we sit with her, with my husband, we run the agency together, and she signs a discharge voucher of 30 million shillings on a Friday that we send out to the insurance company at 2:56 p.m. And same week, on Friday, 11:48 a.m., you have gotten confirmation from the insurance company asking you to call. Sorry, I always get emotional and I don't get it. Asking you to call and confirm if the money has hit. You get, um, that's the other side of maybe this business that people don't see, because maybe as insurance agents, we are what we are blamed for. Maybe just pushing products for commission. But the truth is, for those of us who are represented here and have seen a family go through such a devastating event, and at the end of the day, there's that young, either gentleman who'll receive a 30K, a 30 million check, a 10 million check. And I remember when I called his wife, she told me she was already on Thika Road going to VM to her bank because she had gotten her message in the morning, and she was going to transfer the money to her Jubilee Money Market Fund. At the time, in March of 2024, the Jubilee MMF was averaging 16%. And you could just tell, just the joy of that lady. Of course, very bittersweet, having lost her person, having lost a really amazing, spouse, but knowing that even with the breadwinner gone, that family does not have to succumb to financial devastation. I think that is what hopefully today we'll be looking at. When you think life insurance, think it is that vehicle that's able to stand in the gap when a breadwinner, when an income earner is no longer there to be able to bring that income into the household. And it is also that benefit, that vehicle that's able to give you room, when things are very thick, because maybe your health has been hit, you're still able to keep your children in school. You're still able to keep food on the table. You're able to seek treatment, okay? And it buys you time so that hopefully, if you're able to beat that, you get back onto your feet, and get back to being economically viable. So now, I want us to move on to the next part, and I want us to really ponder on what's the importance of life insurance when it comes to wealth management. Okay, because a lot of people just think life insurance. I want to blow your mind in just a few minutes on exactly how people out here are using life insurance. Number one, we've already discussed this, to do income protection or to do income replacement. Dear Kenyans, dear everyone who's in this call, please, by the way, death is very cruel. And when it hits a home, there are things that those who are left behind will have to deal with. For example, that emotional, strain, like the emotional devastation that family will be going through, the psychological, just the heart, there are things that family will have to deal with. But when it comes to financial devastation, I think we need to get onto the page of realizing that we do not have to leave our families financially ruined when a breadwinner is not there. When you ask yourself why countries such as Singapore, when you check your numbers, countries like Singapore and most Asian countries, where literally they average like 88% of their income earners, 88% of parents, 88, like such numbers, such high numbers when it comes to being insured with the right products. You get, we should start asking ourselves, our penetration is at 1%, and we have places where literally people are insured to the highs of 88%. Maybe there's something that has not yet clicked on exactly what this does in our financial portfolio and in our lives, in our households. So number one, key role of life insurance in wealth management is income replacement. It's also wealth preservation. I want to believe that the bulk of F.A. Julie's community are people who are keen on building wealth. Every time I watch Julie on social media and she's talking of IBKRR, you so much. I'm like, wow, this young girl is so brilliant.
It's IBKR.
Yes,
Yeah.
yes. Now what? And so I know the bulk of your community are people who are keen on what are our opportunities here locally, what are our opportunities offshore, and so on. The reality is we could work very hard to build those multi-million, portfolios, but one critical illness could come and just wipe out that portfolio or wipe out a very huge part of that portfolio. Because if you're holding bonds, let's say what 5M, and a critical illness hits, the reality is there's a high likelihood that in case maybe you don't have medical insurance, or even if you have medical insurance and it's exhausted, you will find yourself having to go maybe into the secondary market to offload those bonds. So when you're thinking of life insurance, please see it as a tool of wealth preservation. It's there to ensure that if I need 5 million, maybe for my medical expenses, I should be able to get that from my living benefits within my life policy. Okay. Another key role of life insurance is what we call key person insurance. I want to believe that we have businessmen in this call, businesswomen in this call, business people. How I wish people would see the appetite for business people out here for what we call key person or key man insurance. And basically, key man insurance is where a business is saying, maybe our CEO or the head of AI in this business is a very key resource. And if we lost him, okay, it would take time, or it would be a very costly affair to try and replace his expertise, to try and hire someone else just like him. So businesses are out here buying what we call keyman insurance. Last year, I saw a gentleman literally locking a life insurance policy through what we call a whole life cover with a monthly premium of 1.1 million shillings every single month. I'm currently in talks with a doctor client of mine who's locking in about 807,000 shillings month on month, guys. And for him, his is very clear. This is Keyman Insurance. It's the business that will be paying that will be paying the premiums. He's 57, so for the next 8 or so years, so he's taking a policy where he's paying up to the age of 65. And his goal is because if I'm not there, he's the founder of this business. He understands, and also the chairman. He's the chairman of the board. He knows in his absence, he wants the business to receive X money that will allow the operations to continue running before it can get to a point where they're able to replace that level of expertise. So, business people, if you're out there is room for you to use life assurance. And what that allows for, it also allows for business continuity, okay, even in your absence. So another key role of life insurance is estate planning enhancement. If there's anyone in this call who has already set up their trust, okay, and I'm talking about family trust here, not really a trust fund. If you've already set up a trust, you do know that one of the key components of your trust is that you need even to declare, like, how much coverage do you have in the, God forbid, in the unfortunate event of a critical illness, or in the unfortunate of a disability, or how have you even planned for your long-term care and so on. So when you think of estate planning enhancement, we are saying life insurance is able to plug into your, estate as at the point where maybe the how would we call that? Like the settler maybe of the trust, when you are no longer there, then the life policy. Please remember, guys, a good life cover. I want you to give you timelines. And if you know me, by the way, this is Hisikweka Chumvi. In this market, on average, life assurance payouts or claims are honored within 90 days. Okay, so from the point of lodging your claim, a life payout is honored within 90 days. But we have the fourth largest life insurance company in the world in the Kenyan market, and they pay their claims within 72 hours. When you sign a discharge voucher, you counted when I told you, Mo signed her. She signed that discharge voucher. We sent it via email at 2:56 on a Monday in the afternoon. And on Friday, that same week, on Friday at 11:48, we had already received an email for me to confirm if she received the money. So we say life insurance pays out, it builds an immediate estate for your family. Okay, so when you're talking of estate planning enhancement, you're saying if there are any taxes within that estate that needs to be catered for, even in your absence, the life payout that is received, okay, the payout that comes from your life cover is able to cover that, cover any other expenses, and so on. Also, business succession. We have seen business partners, they're able to even take joint policies with life insurance so that you can even buy me out, okay, or in my absence, if I pass away, my family can actually get a huge portion from the business that is of life insurance. So the business covers me as a partner within that business, so that when I am gone, my family receives 50, maybe million, 100 million, and they probably even relinquish their claim to that business. Now, to allow my other partners to be able to continue running the affairs of that business. Okay, so that's another way that businesses are able to use life insurance. And lastly, and I think these and income replacement is what we will really be focusing on a lot, inheritance planning. For those of us who are on this call and you are thinking legacy, you probably have a child, and you're thinking, I want to leave something for my loved ones, okay, at the end of the day. Life assurance, there's a misconception out there. It's a huge myth. A lot of people think life insurance is low value. I'll need you to have your your calculators, because in a few slides, in like 2-3 slides down the line, we'll start showing you like how much it would cost you to have maybe 12 million coverage. Life insurance is one of the most high value vehicles you will have in your portfolio. One of the first reactions, especially, and I'm talking about pure life insurance, whole life. One of the first, like the earlier reactions I'd get Kitambo when I would propose pure life insurance to my clients was, "Hey, Charlene, this feels too good to be true." You get, and a lot of times I had to challenge people. You know what? I want you to go to work casual, especially for those of us, for those people who are fortunate to have employer-provided group life assurance, okay? And this is something that all of us, who maybe are in that space can do. Just ask your HR, for this ATM you guys have covered me up to, for this 15 million group life cover I have, could you give me a hint of like how much you pay annually? You will be shook, by the way, by all these big companies. They're paying peanuts and they're able to cover their employees to very high values. Okay, so when you are talking of inheritance planning, if you are out there and you want to build a legacy and you do not have a proper life cover in your portfolio, you are really missing out on a product that can really blow, or really grow that inheritance pot for you. Okay, so first, before we look at the actual quotations, I want us to really go through this really quick. So when there are three key types of life insurance policies out there. And as when we were starting, we say the staple life assurance product in our market is what we call the endowment policy. Okay. And when you're thinking endowment, think education plans, think savings policies. And these are the ones that marry, they bring together protection and savings. Okay. So endowment plans are good when you're thinking of, I want a disciplined way of setting aside money. Okay. But the truth is, at the end of the day, for somebody who is really keen on quote unquote return, you may feel like you have sacrificed the return portion of your policy or the savings or quote unquote like the investments portion in that fund. Okay. But I can still tell you the policies that still fly off the shelf in our market, EIN, when the numbers are coming in, endowment plans are still very popular. That is what we use for education planning, and that's what you use for purposes of disciplined savings. Okay, so that's endowments. Now, one key characteristic you'll find with endowment plans is if you take an endowment policy, say for 10 years, and you save into that plan, the end of the 10 years, the policy then does what we call it matures, and then it ends in Aisha. Okay, so now that's an endowment policy. Next, we have what we call term life policies. Okay, so now term life, and the next one that we look at, this which is whole life, these two fall into a category called pure life insurance. And these are very high value policies, extremely high value. And one thing to note about term life and whole life, they pay when the insured risk happens. So remember, we said there are three key risks that your life policy will be covering you against: the risk of death, the risk of a critical illness, and the risk of a disability. Okay, so term and whole, that's why we say they are pure life, because they only pay when the risk happens. So now the key difference between the two is that your term life cover only runs for X number of years. Okay, so if you've taken, say, 10 years in your term policy, if you get to year 10 and the risk has not happened, so if you get to year 10, you've not passed away, you've not gotten a critical illness, you've not claimed from your accident rider, then that policy in most instances just ends there. Okay, in Aisha too, there's a small variation in the market where you may find a term life product where if you get to the end and you have not claimed, then you are reimbursed the premiums that you are paying, okay, during that time. But all in all, a term policy will only cover you for a particular period of time. And if that risk does not happen during that period of time, the policy ends. And in most cases, you do not get anything out of that plan. Okay. Now, then the last type of policy, and this is what the illustration that F.A. Julie gave in her post, she was actually referring to whole life insurance or whole life. And for everyone in this call, I want you to leave here, just kilala leo. I just want you to be thinking about whole life covers, because all of us just need whole life insurance, people. if you're a breadwinner, if you are a parent, if you have anyone who depends on you financially, if you are a business owner, if you're looking to build a legacy, you need whole life insurance. And the beauty with whole life insurance is that it helps you build, this is permanent life insurance. It's guaranteed. It's called whole of life. It's active for the whole of your life. But now, I told you guys, we in this Kenyan market, this Kenyan market where we still beat insurance agents and the insurance industry at every time that every chance that we get. In this Kenyan market, we literally have the fourth largest life insurance company in the world. They did something when they got the very first time they came into the Kenyan market was actually 1930 during the colonial times. They were insuring their overseas assets. They exited the market in the 80s when the Insurance Act of Kenya came into play, and they returned to the market in 2014. But what I love about what they did is they brought very bespoke solutions in this market. And what the difference they did with their whole of life cover, because if you're thinking whole of life, and if you've ever interacted with a whole life cover before, you probably had to pay premiums for the whole of your life. That is how traditional whole of life covers work. You have to pay premiums for the whole of your life. But in this instance, they introduced what we call paid up whole of life policy. So think of it as a hybrid between a term policy and a whole of life cover. So you have permanent coverage for your life, but they allow you to pay for X number of years. Okay, so you can pay for 10 years, but you're guaranteed you're covered for life. You can pay for 15 years, you have the guarantee that even if you outlive that premium payment term, that estate is locked in. That estate has an inbuilt inflation guard. Yes, that estate has an inbuilt inflation guard, and you're guaranteed that that will eventually go into your estate. So, and I know you'll be able to have more discussions, and Julie will be able to add the meat to this when she's able to do for you the simulations later. But to be able to have a whole of life cover that's paid up, where you can pay for X number of years, then you're done. And still guaranteed of that payout still being made to your family. And it has an inherent inflation guard. Guys, I like to say that is a steal. So we are coming to the end of our presentation so that hopefully we can go into a Q&A session. But I really wanted you to just have an idea of what we are really talking about. Okay, remember we said even when you're thinking of protecting my family, like how much life assurance I need, it's good to start from a point of what is my expense number. I'll multiply it by 12, then I multiply it by 10. That is the sum assured I need. And the reality is this, guys, a little life insurance is better than no life insurance at all. Okay, so sometimes you will do that number. Julie will give you the simulation and you'll see it and you'll be like, so I need to pay 7K, but I'm not in a position to pay 7K. Maybe what I can comfortably contribute right now is 3,000. Please start from that 3K. Because this is the beauty with the life product that you'll interact from Julie's with Julie. This is a very high value product where even 3K, 5K, 10K, 20K, those numbers that otherwise, we go into Java. I remember Julie had that reel where they went, I think somewhere you were spending and also investing like a similar amount.
Yeah.
Yes, but she'll be showing you that even with 3K, 10K, 15K, whatever budget you currently have, you're still able to build a multi-million estate. Okay, so let's look at these different simulations we've done here. These are policyholders who are looking to replace 100,000 monthly income in their households. So they have a 12 million cover. And I worked with a 15-year premium payment term. I think there's someone in this crowd who's like, hey, 15 years is too long. I cannot do that. Maybe the max I can do is 10. It's okay. There's room for 10 years, room for 15, room for 20 years, room for up to the age of 60, and even up to the age of 65. Okay. So you can see here at the age of 25, this person is paying 57.51. At 35, for the same cover that they'll be paying over the next 15 years, they're paying 7,084. At 45, they're paying 11,650. I hope you're noticing the trend. At 55, they're paying 22,200. And at 60, they're at 32,456 for the same cover. Okay. And the likelihood that possibly this premium could even be slightly higher, especially as age goes up, because of possibly, less than perfect health status, is also quite high. So I hope you can already see, because sometimes people ask me, like, Mama Bima, like, I'm young, why do I need life insurance now? Or can I just maybe buy some time? But the earlier you're able to lock in your life cover, the better. Okay, let's look at the simulations for someone who wants to replace 250,000, which would translate into a 30 million sum assured cover. Same numbers with a 15-year premium payment term. You can see at 25, this person is paying 14,302. And at 60, they are paying 81,065 shillings. For the doctor whom I mentioned, who would be paying about 800 plus K month on month, the one thing, because the very first time I met him was in 2021 December. And the one thing he kept saying is, where were you like 20 years ago? I would have bought this 20 years ago, and probably he'd have been paying almost a quarter of what now he has to pay in his 50s. Okay, so there you go. The cost of this cover, over 60 million sum assured, you can see the numbers there. 25-year-old having to only pay 28,554, while a 60-year-old is paying 162,080 shillings for the same amount of cover. And for someone looking to replace 1,000,000 shillings monthly income, which would translate to 120 million in sum assured, a 25-year-old paying 57,058 shillings month on month. And I know someone out there may be thinking, which 25-year-old is out here paying 57K? No, but then this is just for purposes of simulation. Here, sifikiria ati these young Kenyans got these gig workers at in your church. I remember, so we're in 2026, I mean, in 2024, being blown away by a very young, client of mine, a mom of two at 27, taking a life cover of 70,000 shillings and setting up a family trust same year. And to date, still so, diligent with her premium payments and so on. So also, Kiona, how at Toto, but they are locked in, and they are also earning very well. So just for purposes of simulation, I wanted you to see these numbers where a 25-year-old could get this policy at 57,058, and the same amount of coverage could translate to 324K just because of what we call time. Okay, so I think this brings me to the end of our class this evening. I am truly grateful for the opportunity, Julie, I must say, to interact and share. If there's one thing that I like to say is beyond being an insurance agent, and God has been so faithful. I've enjoyed, relative success in this business in just a few years of being in the business. But one of the things I love to do is to show up and train. But then people call me, I run 20 technical phones. Like I want to play a role, even if that business is not coming through me. I want to go and play a role in that part of educating. Okay, so Julie, it's truly a big honor. Thank you for the invite to come and teach this class to your community. And it's my hope I'm so happy to see you also sharing such crucial information, to also people who love you, who trust you, people who follow you, me being one of them, are also sharing crucial information on the importance of sorting your protection portfolio within your financial plan. So, asante sana. Before we go into the Q&A, I would just want to make one, like a final call to action to everyone who's followed this, class. Kindly, guys, please reach out to this lovely lady, okay, who's brought us together into this call. Reach out to Julie for a bespoke quote. What you just looked at, those are high level, just quotes. You'll notice those didn't even have critical illness riders, they didn't have the accident riders. Julie will be able now to sit down, better understand your needs, do a proper needs analysis,
Yes.
and come up with a
Before nianze
solution
kusongesha
that
Helen nikifanya kazi ya Dragon.
Sorry. Let me just mute them. Sorry.
Okay, lovely. And come up with a solution that really answers your needs. And
Yeah.
remember, my last call to action is just start. A little life insurance cover is better than no cover at all. And by the way, you can build it over time. Okay, if I were to show you my portfolio, the first whole life cover I bought in 2021 April. I was still relatively new, but when you've left formal employment and umekuja ukakuwa insurance agent sasa, and you start from zero and it's a commission-based business, I was still struggling, especially back in the day in 2021. And the cover that we took with my hubby, I remember we were paying like 6,500 per person. 6,565. And a year later, 2022, October, each of us like added like a 10K cover. You get like Neil, by the way, you look back. I remember, especially my policy, I bought it on October 31st on my birthday. Feel free to send gifts because this will be a big one. This year, October 31st will be my 40th. But I remember we added a 10K policy. Okay, because we were now feeling confident. You know what? Maybe our income may increase kidogo. Let's add, our coverage. And since then, we've just been adding pole too. So please be sure that your first policy is not really your last policy. You will have room to add your coverage over time. And in life insurance, we do not have double coverage. The ceiling that has been set right now by most reinsurers in the market is 500 million. So between 1 million and 500 million, you can actually add that coverage over the years. So thank you so much, everyone. Back to you, Julie.
Oh my, sijui nani anasemanga hivyo, but yeah. Oh my God, Charlene, this has been extremely insightful, even for me. I feel like I'm always learning something from you, especially from an insurance perspective. So my key takeaways out of this and this has come at a really timely manner, especially for entrepreneurs. I don't know how many of you knew about the Keyman insurance, right? As part of your business continuity plan, especially when you're building your business. So that is quite an interesting way to use life insurance. And then we have the thing about like life insurance by Prudential being honored within 72 hours, right? So you don't have to like struggle in case anything happens. So those are extremely insightful points. Now, thank you so much, Charlene, honestly. And I especially just liked the point about like insurance is not about, getting rich, but it's also about protecting what you already have. I talk a lot about investing in global markets, investing in bonds, investing in all these other asset classes. They're all fine, right? So you can imagine you having a portfolio of around, let's say, give or take 10 million. And then today something happens and you are diagnosed with a critical illness. So it means you'd be forced to liquidate your investments. And you know how erratic the stock market can be. Maybe you've invested in a very good company like Nvidia, and at that point where you're diagnosed, you need money very fast. Then you end up like liquidating your investments. So life insurance pretty much comes in to ensure that you do not liquidate what you already have, and you also don't put your family in a point where they'll have to I don't know, form WhatsApp groups and start begging people for money. Apana. And one thing that I like emphasizing when I'm talking about wealth building is that we as parents, if I know there are parents in this audience, is that we are bringing a generation who are going to grow up in abundance and not scarcity. I know some of us, tumelelewa, we love our parents, but we also understand the struggle that we've been raised up in, and we don't want our children to grow up in similar struggles. So thank you so much, Mama Bima, for that. I love the session, and we're going to take a few questions, and I can already see they're in the chat. So allow me just to read some of them, and then you can take them. So we have Rosemary. I think I've answered you. So there are people who had already they were interested in the illustration that I was talking about in my video. So if you had already formed that form, then you don't need to fill in the form again. So, but I'm going to send this form. Let me just share it in the chat. For anyone who is interested in life, in the whole life conversation, and you want to get your own illustrations, you want to see, I'm able to contribute like around 10K per month. How much can I get in terms of sum assured? So just fill in that form, and then I will send an email with all those illustrations. So Rosemary, that I have answered you, and then you can always continue with the conversation. Now, Mama Bima, this is for you. Eunice is asking, should we include the life assurance sum assured amount as part of one's net worth portfolio?
Oh, great question. By the way, when we are talking about net worth, we only think about our living net worth. Do you get? There are two types of net worth, guys. There's living net worth, and then there's legacy net worth. Okay, so living net worth is what we normally count right now. My shares portfolio, my bonds, da 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 da. But there is legacy net worth, which is what then would pass on to your loved ones when you are not there. So definitely your life policy definitely counts as part of your net worth. Okay? Because remember, especially when you are talking of permanent life insurance, remember, this is not term. There's no possibility that, if I outlive this plan, I will not get, or my loved ones will not get this. Okay. So, however, I would say, especially in the case where you are thinking, I have a 10-year term, get it to the end, because maybe what also didn't come out in this, in the class is that one time where now you can say for sure, I have locked in all this wealth for my family. You need to also ensure you get to the end of the premium payment term. However, please note, when you take your life policy and it goes into effect, God forbid, even if you were to pass away a day later, a week later, as I told you, my client who passed away in 2024 January, he had been on that policy for 23 months. His critical illness payout was made on his 18th month. When it was paid in full, he had a 5 million cover. The 5 million was paid in full. He passed away in Jan of 2024 on his 23rd month. And the 30 million was paid out in full. And later that year in May, the what we call the bonus on that policy, which was 750,000, which had accrued in 2023, throughout 2023, was paid out still to his family. So yes, in the case where you have permanent life insurance, that definitely falls into your legacy net worth. I hope that answers you, Eunice. I hope that's clear, Julie.
I was on mute. Yes, that is very much clear. Yeah, thank you for that. Daisy is also asking, can one change from an endowment policy to life insurance? And this is something that we really need to talk about. And I think I've gotten, I've come across people who were sold an endowment policy, and that is not what they were looking for. So they are like halfway towards paying the endowment policy, and then they realize, yo, this is exactly not what I'm looking for. So the question is there a way they can change from that to a whole life insurance? And what other remedial processes can they go through to maybe, I don't know, terminate? I do know it can be costly, or you might end up whatever you've been contributing. Yeah.
So no, that's not possible. You cannot switch from an endowment plan to a pure life cover. This is what I say. If you sit down, you see, there are some people who love endowment so much. I must tell you, there are people who love endowment so much in this market. Like a good friend of mine, a guy who sells for like the biggest life underwriter now in the market, local. He sold like a policy of like what endowment here 1.3 month on month in November of last year. So the appetite for endowment is still big out there. The big girls and boys within the insurance space are selling crazy numbers. But there are people who've gotten to a place where, and I say especially the younger generation, you're doing your math, you're like, um, FA Julie has already showed me that I can make a much higher return if I do XYZ. So I want to separate maybe my investment from my protection. So I want my protection to be pure life, and I want my investment to be optimized through an investment vehicle. If that is where you've reached and you've made peace and you're probably feeling that, you know what, I want to exit, please sit down with your agent or just even come, to Julie. And even Julie could even drag me into that call with you just to give you just a review. I probably understand every other product in the market. You name it, whether it's a Britain product, an ICA product. I can give you a balanced, just balanced advice on that. Okay. But what I say is it's good if you can go back to your agent, sit down, crunch the numbers. Remember, an endowment policy has an exit clause. Okay. So you can either surrender that policy if you do not want to continue with it. Of course, there's something you may need to have met, for example, the number of years that you've been contributing into that plan. So if you're at that point where you do not want an endowment anymore, look at how do I ensure that I do not forfeit this policy altogether, But I must tell you, in most cases, there will be a haircut. Okay. And this will vary from one insurance company to the other. There are companies where by the time you get to year 4, by the way, of being on that plan, even when you surrender, you actually get even more than you've already contributed. Okay, so it's not all a massacre out there, of course. And I know there are plans where I have seen a client surrender on month 37 and only get 38% of the premium they contributed. And that was mightily painful to them. Like they felt it, they really felt it. But at the same time, I have seen clients also exit from policies and even be able to get more, slightly more than what they contributed as premiums. So I would say sit down, look at what your exit clause will look like, and possibly now place a position into now the pure life cover. Or the other way could be if you are maybe towards the end of your endowment plan, you could just decide, you know what, let me sit this out until it gets to the end. And maybe now in future you'll already have learned that maybe endowment is not the right solution for you. I think that's what I like to say. And Julie, I'll tell you why I do not fight endowments so much. It's because over the years I have seen, especially when interacting, with parents over my years of also selling products such as money markets and all, the truth is a lot of Kenyans also struggle with their savings discipline. The younger generation is definitely doing much better, I must tell you. But the reality is many people in Kenya still struggle to set aside that money. You'll put that money in that money market fund, and 3 weeks later, umeyendea. 2 months later, something has come up, and you need to pick it either to go firefight. So there are people who endowment plans actually work for them, and they've made peace with the fact that yes, the quote unquote, like the ROI on this is low, but I just want a way that will force me to set aside that money. Okay. But if you're in a position where you're saying, that is not me, please look for exit clause, sit down with your agent, don't ghost them, just sit down with them or come for a free, review session. We'll take you through your policy document just to understand how that will work and then place a different position elsewhere. I hope
Amazing.
that answers you.
Yes, that is actually very spot on. And also, Eunice is asking, Does a whole life policy and an yearly bonus during its lifetime, similar to what some endowment plans offer?
Let me tell you, Eunice, and I love that. I can tell Eunice is part of the people who are insured. um, Endowment policies are mind-blowingly high value. And the bonus, I want to show you something, okay? I want us to go and work with this whole life cover. I want us to work with the illustration for the 12 million cover, okay? Or Julie, get your calculator out. You help us here.
I
So with
actually
this,
I have a compounding calculator, but yes, continue.
yes, we'll just use a simple interest because the interest on this is usually simple. But each year, this particular whole of life cover has an annual bonus on the lifetime of this policy, not just over the 15 years that you're paying premiums. It's on the lifetime of the cover. And this bonus is not on the premiums that you are paying. The bonus is on the sum assured. So Julie, do for us, what's 2 point, okay, here tanakusumbua hii najua, 2.5% of 12 million. That is what? Is that 300K?
300K, yes.
Yes. So in this case, all the clients represented here from the 25-year-old to the 60-year-old, their policy would be adding its value year on year with 300K. I want you now to do the math for us, Julie. For this 25-year-old who's paying 57.51,
Yes.
how much is that annually? What is 57.51 by 12?
So 57.51 by 12. That's 69,000.
They will have paid 69,000, but their plan will accrue an annual bonus of 300K. Guys,
Wow.
I mentioned something when I was taking you through this class. Getting a whole of life cover that has an inherent inflation guard where you're not being charged for that inflation guard, because most of the other traditional whole of life covers, when you have the annual bonus, then your premiums increase year on year. This particular, the best whole of life cover in the market, your premiums don't increase. Okay, so I loved what Julie said in her illustration in the reel. She told you, yes, the bonuses are not guaranteed. Okay, this is a projected bonus. But if you look at the history of this particular whole of life solution, since it was introduced in the market in 2019, they have issued a bonus of 2.5% every year since then. Okay, I keep saying participating, because we call this type of whole of life cover participating whole life insurance. Participating whole life cover is a steal, you guys. Even whatever will be coming in as bonus, remember you already guaranteed 12M. Julie, this 57.51 by 12 multiplied by 15. So over the 15 years, how much will this person have paid as premium?
We're looking at only 1,035,000.
Yes. 1,035,000, and during that time, there are 300K. If it participates every single year for the 15 years, that will translate to 4.5M, right?
Yes,
And
yes.
then, so they will have built an estate of 16.5 million, having contributed 1M. Guys, I keep saying, who does that? Like, what vehicle does that? What vehicle do you place a position even with just 5,751 shillings? And from day one, you are guaranteed 12 million shillings for your loved ones. Yeah.
That's amazing. Yeah. Sorry,
Yes,
sorry.
back to you, Eunice. Yes.
Yeah.
Yes. Back to you, Eunice. A good whole of life cover will participate. It will have bonuses, but not all whole of life covers in the Kenyan market actually have a bonus. So make sure you get back to Julie. She definitely has the best whole of life policy in the market. She distributes it. Yes.
Charlene, there's again regarding that video, and we're going to use this illustration of 57.51. Somebody asked, I'm only contributing 20,000 every month, but I'm getting like a payout of 26 million. Where's the catch? The math is not mathing. Let me just share my screen and we do this together. And we're going to use this illustration for the 57.51. So the assumption here is if we were to contribute this in, let's say, a money market fund, right? Where we are doing like a 57.51, just a conservative 10% interest rate for 15 years. Ideally, you're getting like, how much is this? 2.3. But Charlene is here telling us with the whole life insurance, I'm getting around 60 million. Yo, where's the catch?
Yes.
Yes, you expound on
Let
that.
me say, and this is it. I think even in my presentation, because I always know these things are always coming. That sounds too good to be true, right? I told you. Guys, please note, this is life insurance. The reality is, even as we plan for the what if moments in our lifetime, the truth is we are also believing God that we shall be blessed. First, these babies that we are raising now, we shall see them until they're big, big, big girls and boys. So we'll live into our old age. That is what, we are claiming from God and from God's promise. So at 39, if I'm starting a 15-year term, I will pay for this premium until I'm 54, thereabout. And then after that, I stop paying premium. But probably the insurance company will still have this money for another 20, 30 years. If you realize that, for that 25-year-old who pays $1 million bob over a 15-year period, please remember they're contributing their 57, 51 month on month. And even after the 15 years, the insurance company probably continues to hold that money. Okay, so 30 years later, possibly that is when the estate is being paid out. One thing you need to understand about life insurance, that is why a life cover will go into effect. The policyholder passes a month down the line, and the entire life, like sum assured, is paid out to the family. It's because, think of it this way, insurance
Why am I
works with a
leaving my money to my family?
Sorry.
Yes. Insurance works with a pool of premium, so it's a pool of funds. So you have different clients sending in premiums to the insurance company month on month. Okay, so when one family is befallen with the worst, when death happens, and a breadwinner is picked from that family, then the insurance company is able to dip into that pool of premium or pool of funds and restore, or what we say, indemnify that family's income. Okay, but the probability is the majority of those clients in that pool of premiums will outlive that premium term, and the insurance company will have time to invest and reinvest. And that is how insurance companies are able to justify very high value products.
I love that.
If I may just say this, Julie, because I know a lot of us also in this call are formally employed. Please, I give you an assignment. Most of us, maybe our employer is giving us 3 times our annual income as a life cover. Others are maybe getting 1 time. Others could be getting 5 times. Just walk into your HR and ask them, by the way, for this cover, ever give me an average of how much you pay? You will notice very high value life insurance has always existed. If you've ever taken a mortgage and you look at the life insurance, like whatever you pay for the premiums for your life cover for that mortgage, very small, to give you a cover of like 15 million shillings. And the truth is, we do know that anytime someone who has a mortgage passes away, Credit Life steps in. That is life insurance, guys. It steps in and ensures that the family gets to keep the home, because the insurance company now clears that with the family. So high value life insurance has always existed. Anyone who's ever bought a vehicle with a car through a car loan, that car loan has life insurance. Just do your math and see how much you are paying maybe for that 4M or 2M or 1M, loan that you've taken. Very little money. Okay, so high value life insurance has always existed in the market. It's only that it was only given to corporates. It was given out as group life insurance. It was given out as credit life insurance. And finally, it's coming into the market now for us as individuals. I hope that answers you, Julie.
Perfectly. I just wanted to clear that question. Kiri is asking, if I got it correct, whole life extends the term even if the contract we signed was a 10-year plan until the risk happened. And must the risk happen?
So with whole life insurance, we said it's a pure life policy. The risk must happen. All of us, we can agree that all of us will exit, like all of us will at one point finally pass away. And that's the thing with whole life insurance. If you're on a whole of life cover, that is the guarantee that comes with it. At whichever point you finally pass away, that is the point when your policy now, your sum assured, will be paid out to your loved ones. Please note, when you talk of a 10-year term, if I am 39 and I take a 10-year term, at the age of 49, I will stop paying premiums. I'll be given what we call a waiver of premium. And with that waiver of premium, it just means going forward, I will not pay any more into that policy, but my cover will be permanent. And whichever point I finally transition, then the payout is made to my nominated beneficiaries. I hope that's clear.
Yes, that's clear. Thank you so much, Charlene.
Yes.
Then Camila is saying that I find these policies are only for those who have money for such policies. Are there policies for low income earners, nannies, etc.? And this is what you want to demystify. Over to you, Charlene.
Genuinely, this policy, so I know there's usually that feeling of, I need maybe 20K to contribute into this plan, depending on your age, dear, and depending also on the premium term that you are paying your premiums. You may find that your premiums could even be less than 2K month on month. You get, I do have young clients who started like 1,800 and something, and that's their commitment month on month. I get couples who come in and start at 3K. Then after some time, you see they'll come and add, maybe 2 years later, they come and do a 5K policy. So genuinely, I hope that you really can see that, this is a plan. Of course, there's a monthly commitment to it. And I do not want to belittle and talk as if 2K is not a lot of money. I know it's a lot of money. But yes, there's room for you to start depending on your age and the premium term that you're taking. There's actually room for you to start from about 2,000, 3,000 shillings as your monthly contribution. Yes.
Nice. Back to the maths again. Camila, I hope you're still in the meeting. She's asking, why would I take a policy if I can save 100,000 per month for 15 years in a good investment fund that can give me a return that compounds? That compounds. So I think she's done her maths and it's giving her like around 14.4.
Okay. At what percentage is that? And how much would she be contributing?
100,000 per month for 15 years in a good investment fund that can give me
Yes.
a return that compounds.
Yes. And this is not me. So please remember, it's not a question of investments versus insurance. This is, I hope the conversation you are getting from here is investments plus insurance. But I also want to tell you what, let's use a 30-year-old in this case, okay? 30-year-old female who doesn't smoke, who's taking a single life cover with a whole of life policy where she's paying over 10 years. Was it 10 years in the investment?
15
As
years.
compounding, or 15 years. So
100.
with 100,000 shillings being paid monthly, the sum assured for this in a whole of life policy would be, I need to read this again. It would be 199 million shillings, 650,042 shillings. I hope you've gotten that. It will be the same 100K over the next 15 years in a whole of life cover for a 30-year-old is 199 million, 650,042 shillings. Guys, this is not a question of whole of life versus investments or insurance versus investments. I hope you are able to see the place of whole life insurance within your portfolio as a way of building generational wealth and also doing for you income replacements. And you do not need, for example, if you are blessed enough to be able to invest 100K, possibly to cover, if you wanted maybe a cover of, say, the 15 million or 14 million, you would note in a whole of life policy, if I wanted to build an estate of 15 million, by the end of the 15 years, I would be paying 7,559 shillings per month as premium. Okay, so in my investment, I need to do 100K. And by the way, these are two very different products. In my investment, but to build to about that 15M, I need to set aside 100K. And in a whole of life cover, I need to set aside 7,500 shillings for pretty much like the same value. All I'm saying, and please remember, if I start my investment of 100K today, okay, and God forbid tomorrow I'm not there, my family will be paid 100K plus maybe the interest that accrued over that 1 day or 2 weeks or 1 month that my investment was running. The person who had 100,000 in their whole of life cover, their family will walk away with 199 million shillings, guys. So please, I hope we can see the role of life insurance, the role of locked in legacy, locked in income replacement. It's not this versus that. It's meant to be a very complementary role. So please go ahead, invest that 100K in the vehicle that's compounding, but at the same time, ensure that that wealth that you're building is also protected. It will probably take a very small chunk. And even that 100K that you are building and is probably even giving you an interest over time, you can just pick a small portion of that interest to just fund a small life cover for you.
True. I like that. I like that, Charlie. And also to add on that, again, as you've said, and just to emphasize, these are not competing products. They are supposed to be complementary. So with your 100,000, as she's mentioned, again, just put a small amount into life insurance. So essentially, what this does is that in case anything happens to you, it means your life insurance, okay, God forbid you get diagnosed with a critical illness, you will not go back to liquidate, your money. Let's say you'd invested in bonds or a special fund or shares. You not go back and liquidate all those investments, but your life insurance with all these other riders can be able to support you in the event anything happens. So Camila, I hope that is clear, and also to anyone else who had a similar question. Again, coming to an end, let me see. HPNV is asking, what happens to policies if and when an insurance company collapses before the payout period? That's a very good question.
Okay.
Thank you
Good
for that.
question.
Yeah.
Yes. So you'll notice it's not that every so often, not often, but once in a while, you'll hear of an insurance company that has gotten into trouble and like they're put under receivership and so on. And I think, a recent past, we saw that happen like to Resolution Health, which was mainly like a medical insurance underwriter. In the recent past, we also saw, a few companies here and there struggle, especially general insurance companies. You rarely hear of life insurance companies. True or false? It's not that they also don't struggle, but if you think about it, when you think of all the big global life underwriters that have come into the country, from the likes of Sanlam, recently just saw Sanlam rebrand to Sanlam Allianz. I hope you guys know that Allianz is actually the biggest insurance company in the world. Okay, so they're sort of like taking over Sanlam in Africa. Maybe over the next 8 or so years, Sanlam now in like 33 or so markets will now be fully Allianz. But you will start to notice, how did Sanlam come into Kenya? They came and acquired the Pan Africa life business when it was struggling. And how did Julie already let the cat out of the bag and told you which is this fourth largest life insurance company in the world? Prudential Life Assurance. This is Prudential, the largest life insurance company in the UK. How did they come into Kenya in 2014? They came in and took over the book for Shield Assurance. I hope you guys, if you remember, there used to be an insurance company called Blue Shield, and Blue Shield went under, but the IRA rescued the life insurance arm. So when you look at long-term businesses, in most cases also, please remember, beyond the insurance company that you see, that's the one that's underwriting the business, behind them, there's a second layer of protection of who we call reinsurers. The likes of Africa Re. You may be hearing of Akina Continental Re, Africa Re, Kenya Re, da, 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 right? So there's an added layer of protection of reinsurers, but beyond that, the way the market, and especially the Kenyan market, has been done is if a life business or what we call long-term business, that is pension and life insurance, if a life business gets into trouble, IRA will like invite an international company to come in, acquire that license. And by acquiring the license, you also acquire the book. For example, the first 3-4 years of Prudential getting back into the Kenyan market, all they were doing was clean up the Shield Assurance book, pay all the maturities that had not been honored, look out for their clients. By the way, it was ilikuwa footwork. They would send their people, sijui Bungoma, sijui Murang'a wapi, you go with the ID, unaenda kwa chief. So ID kumeandikwa, this person is from Muruka location, ama Kafuruge village. So you go to Kafuruge, you look for the chief, anakwambia, Stacy, familia yao ni ile. So you go to that family, then Stacy lives in maybe in Roysambu. So unakuja kumtafuta, you get. So it's usually a very, it's a lot that's happening behind the scenes. But when a global underwriter, in most cases, will come into the market, they will come, acquire the license, and pay the maturities that maybe the company that went under was unable to do that. So that's how we saw Sanlam come into the Kenyan market. You also saw Liberty do the same, come acquire the CFC, life business, and so on. But yes, there's always, and beyond that, you will always notice when you buy like your life policy, there's usually what we call in the breakdown of the premiums that you're paying. Your cover also has some element of insurance to it. We call that the policyholder's compensation levy. Okay. However, that one you're covered up to a maximum of 250,000. So the mechanism that the regulator in our market uses is to get a much bigger brand to come and acquire the struggling business.
Amazing.
I hope that's clear.
Yes. Well explained. Then there's one who's asking, when a couple signs up, do they make the payment for a joint life policy, or premiums are paid individually?
So, and I know Julie will be able to elaborate this for you very well when she's making simulations. I would say, depending on the premium that you are doing, in most cases, it's actually better to have individual policies. You get more value if you're on individual policies versus being on a joint cover. So as a couple, remember, couples have what we call insurable interest. Okay, so you have insurable interest on your partner and vice versa. So when you sign up, one partner can be the one who's funding both policies, even if they're individual. So you can even set up a direct debit from just one bank account, like Talipa, both your policy and your wife's, or vice versa. So, or you can also just come in, get 2 individual policies, and just pay your premiums individually. So yes, that happens. Yes.
Thank you for that. And then just a few last questions. What's the age limit for a life cover?
So depending on the different providers in the market, we have those who their maximum age at entry. Please note, not on cover, maximum age at entry. Some will be at 60. They'll cap that at 60. And some will cap that at 65.
Okay, nice.
Yes. So, and that means that a 60-year-old can come and buy like a 10-year policy and pay up to the age of 70. That's what I mean by that.
Okay, that's clear. Yes. And are you able to change your monthly contribution with time? That is from Peter. And does that change my sum assured?
Yes, Peter, you can change either increase or decrease your monthly contribution. But please, if possible, please do this. We call this an endorsement. Do this endorsement within the first year of the policy running. Do it before that policy hits its first year anniversary. Okay, because after first year anniversary, especially if it's a participating policy, it's already acquired bonuses. It becomes very hard to endorse that plan unless you are reducing the premium. Many times adding onto that existing plan becomes hard. So the alternative or the solution now to that is you take another parallel plan. So let's say you started out on a 5K plan. 2 years later, 3 years later, you feel, you know what, I can add, I can contribute another 10K. I want to build this portfolio. You just buy another policy. Both of them will run concurrently. And as I told you, in life insurance does not, the policy of indemnification does not apply to life insurance. So it means at whichever point the policyholder finally transitions, all the life policies that are in the book will be paid out to their loved ones. So you can have more than one cover running concurrently with the others.
Amazing. I do not think we have any other question at this particular point, and I know we are running out of time, but thank you so much, Mama Bima. This has completely been insightful. I've also learned a lot, and I hope the people who joined have also learned as well. And so as we wrap up, I just want to emphasize one thing, that again, insurance and investing are not competing tools. They work hand in hand together. So again, investing builds your wealth, and then insurance protects it. Yes, so that's it from us. Thank you so much for joining today.